Hey everybody, welcome back to another beautiful day in real estate. Today we're actually going to dive into why the economy is on the last leg. Anybody out there who's looking to understand about the economy, this video is going to be for you and why you should be preparing for one of the biggest crashes that we have seen in recent history. Now, before we dive in, we're going to do as we usually do. Let's touch on interest rates. Interest rates have not moved since yesterday. Everything is basically around the same. There is a lot of anticipation that the war in Iran could be reaching its potential end for the 15th time at this point. Right now, there is talks of finalizing a peace deal. Before, there was a lot of talks. We are getting it started with one. We've met here. We've negotiated here, blah, blah, blah. But it sounds like we're getting closer and closer to the end of the rope, which from the perspective of the economy, it's needs to happen sooner rather than later. And here's why. Because, well, let's dive into oil first, talk about the S&P, and then we'll dive into some of the data and why this absolutely needs to happen sooner rather than later, or our Q4 is gonna suck this year. So oil prices have found a fair bottom here around that $90 to $88 a barrel. We talked about this yesterday, you guys. This has been the strong support. We've seen volatility here, a major volatility here, bottomed right around here, touched here, and then we're back down. We talked about this the last couple of weeks. We saw the high, we saw a double top, we saw a lower high, and now we're seeing ourselves in that $90 a barrel range. Until we see that peace deal, it's going to float right around $90. If we see a peace deal, expect a flash crash. I'm not going to say it's going to go all the way back down to $70 a barrel, $50 a barrel, whatever it was. What did we see? What do we sit now? Yeah, $63 a barrel before the war. But I am expecting that this is not going to persist for very much longer. I think we're close to the end of the rope here. I think we've reached that point. If we're looking from the technical perspective right now, I mean, let's talk about the general gist of things right here. So, I mean, we've seen, let's get rid of this. There we go. Okay. So right here, this is the daily chart. Again, I always refer to this WTI crude oil daily chart. I pay attention to the next 3 days. I pay attention to the next 72 hours. I pay attention in threes. 3 months is a quarter, right? I pay attention for 3 weeks, 3 days, because that is a probability market behind it. That means that you can properly go, this is what I'm anticipating for the next 3 weeks, the next 3 days. I'm expecting for the next 3 days that we're going to see oil prices continue to stay stagnant or go down. I don't think we got any more gas in the tank unless something randomly pops up and they say, peace deals are off, the war's back on, mines are in the Strait of Hormuz, China is no longer working with us, whatever the case might be. And the reason is because on the stochastic, and I'll double click on this to magnify it here. And, you know, now we can zoom in a little bit. Let's get a little bit nerdier with this right here. So, I mean, granted, we saw a little bit of a pump above this one, but let's just use this for reference right now. We're seeing lower highs. I mean, relatively 1, 2, 3 lower highs broke below, and now we're towards the bottom. Anything below that 30 range for the RSI is going to be an oversold, which means you should probably gear up and start getting ready to buy because we're probably going to see a move to the upward. Doesn't mean it's going to be a fast move. Doesn't mean it's going to be a big move. But it's usually a pretty comfortable place, right? That just means buying pressure is low and selling pressure is running low. I'm sorry, selling pressure is running low when you're on that side of the RSI. So everything is kind of staggering out. People selling out for the time being. Again, until we see some resolution, it's just going to kind of be there. We have the S&P 500. This is the first crack in the system that we need to talk about today. We are in what we call a blow off top, and my God, does it look pretty juicy. After we corrected our trading channel the other day, I mean, the amount of perfect this was that bounced right off the top of our channel, which has been building since 2009, by the way, the great financial crisis of 2008 into 2009. I just think it bottomed in 2009. But anyways, this right here shows me in no general perspective should we be at the S&P should be at all-time highs right now. There's nothing. No liquidity in the markets, no peace deals, no world peace, no general growth. Majority of this stuff is coming from AI. 18%, if I recall, is 18 to 20. Why is that number in my head? But 20%, something like that, of all of this is coming from AI companies. AI companies, or companies using AI, I should say, not AI companies. But here's what we need to be paying attention to. We are talking about a dot-com bubble on steroids, and it's getting more and more pertinent You have Michael Burry, who has shorting heavily in Palantir and NVIDIA right now. You have Berkshire Hathaway, that is $397 billion in their cash reserves as of right now. You have jobless numbers that are up as of today. So let's jump into those real quick. Jobless claims today, up today from the previous of 210,000. Expectations 211, we're at 215. Higher expected print signals a softer labor market could support rate cut hopes. Not quite. They're focusing on inflation more than they're focusing on jobless claims. Now, typically in a standard market, you're going to see jobless claims go up, which means they're going to say, oh, the economy is weakening, so we need a lower interest rate so that more money can be pushed through the economy. But right now, we had the S&P, or we had the we had US GDP pop out. US GDP came out today and it came in below expectations again, so we're not looking great, right? The actual is 1.6, the forecast was 2%, meaning we were still going to see an increase in GDP by 2%. We only saw 1.6. Price index 3.5, a forecast 3.6, previous 3.6. I mean, growth came in weaker than expected while inflation pressures eased slightly. So, and we also had the inflation pop out. We had the inflation numbers come out today. 3.8, I believe the number was. 3.8 is where we're sitting, which means we're well away from the 2.0 range. But again, the inflation is coming majorly from the energy sector, right? So you have to remember that all of these numbers that come out are a general sum of the entire category or the entirety of the market, right? So when we're talking about inflation, it's not just food prices, it's not just the cost of goods. It is including, gas prices at the pump, that gas for your home, natural gas, electricity, right? The entire energy sector. So it's not just, it's not just one thing or the other, but what they typically do is they cherry pick the things with the lower interest or inflation and they put it together and they're like, here is where the average inflation is and here's why. And then they pull the data and they show it to you and blah, blah, blah. And you feel like, oh, well, 3.8% isn't terrible. I'll be honest with you, 3.8% is pretty garbage. It's not great. And here's why, okay? Because those of you that are in your 9-to-5 job, just like me, I'm in a 9-to-5 job. Granted, mine is more of a commission base, but I still consider it a 9-to-5, right? I still have to show up every day, do the work, and some days I can call in sick. But anyways, you don't typically get a raise more than 3% in a year, right? So the people that were making $100,000 last year are making $103,000 this year, right? But inflation sets in, saying it's a 3.8%. So technically, you're making about 0.8, almost a percent less than you were last year. On paper, it says, yeah, I'm making money. I'm making $103,000. Yeah, I'm beating the system, making money. But the value of that money is 3%, 3.8% less than it was last year. So that 103,000 is actually more like a 98, 99,000. 99,000. So it's a gradual, slow increase in inflation. And we saw the 9%, 8% during 22, 23. That was after COVID. I don't care who was in office at that point. People can point fingers, but really relatively, you have a problem because they printed so much money at the time. They overinflated the markets with liquidity, and then they rose interest rates significantly. Inflation peaked, started to come down, but here's the thing, that 9% still went in there. So basically, you lost 9% of your money between 22 and 23. 9% of your value. So again, we're using the $100,000. You had $100,000 in your account. Technically, the value is only at about 91,000 now compared to where it was in 2022. That's the problem that we're seeing, right? So when inflation continues to come at 3.8% or higher, you have to be increasing your net return on your money by 4% or higher to even break even or start to generate any sort of cash flow. That's why so many people are moving to the stock market right now, because the stock market is so volatile. But the problem is it's so overvalued. You have so many companies that are overvalued in the stock market. And then you have major IPOs coming out, SpaceX. I do think that is going to cause more harm than good. Over the short term, it might produce. But in the long term, you have companies in the S&P 500 right now that are not profiting at all, but their valuations continue to go up. For those of you that understand how businesses work, how the hell does a business get more valuable when it produces and misses less than what it's supposed to every quarter? ChatGPT came out, or OpenAI, and supposedly they missed earnings already. These AI companies are not hitting their numbers. Like, that's one of the most used AI systems out there. I use Claude now, Perplexity, and other ones, but it's one of the biggest, average AI that people use, and it missed earnings. Companies are now overvalued because of AI productivity, and that's the problem, right? So let's flash back to 2000 when we had the dot-com bubble. The dot-com bubble was companies over leveraging the internet, or people were over anticipating the internet. And the same thing is happening with AI now. It is a very beneficial tool. It will be in 5 years, in 10 years, it will replace productivity. It will create more cash flow. It will create business growth. But the thing is everybody's giving it so much credit now because, well, it's the new thing and it works and it does all these things. And like, let's set that aside. What happened in 2000? Tons of companies popped up out of nowhere that were internet-based companies, and then all of them fell in on each other. Maybe 1 out of 10 survived, right? Maybe 1 out of 100 survived. Cryptocurrency and blockchain is another portion of that, and then you have AI, and you mix those two together. The over anticipation of the market growth is scary, and that's why I think we're going to be leading towards a crash. I mean, that's just one factor, because, like, let's be real here. If a company's not profiting and beating expectations on earnings, how is the valuation going up? Well, it's getting supplemental income. It's getting propped up by other investors, right? There will come a time when these investors pull their profits and take their money, and you all are going to be holding the bag. And when I say you, I mean me too. I mean, if I'm not careful and I'm not investing smart, I'm going to be losing a lot of money in the next few months, next few years. I don't know exactly when it's coming, but there's a lot of things pointing towards the market's going to crash. Here's another thing we should pay attention to. Taiwan's market surges to the highest level on record, well, another 50% this year. This also should be very concerning. Taiwan now has the 5th largest stock. Why do you think Taiwan's market's ripping so hard? There's one company that sticks out to me in particular that's based out of Taiwan solely. What is it? Oh yeah, NVIDIA, the company that has seen 15,000% increases over the last 10 years, or excuse me, over the last 5 years. A semiconductor based company that's basically establishes. I have a NVIDIA chip in my computer right now. Not chip, graphics card. There we go. I have a NVIDIA graphics card in my computer right now. They are used in that basis for, building PCs, which is very popular. AI centers and data centers now is what they're generally using them for. But again, we're in a time where so much money is being invested into these companies, they're overvalued. And when you see this overvaluation of such extents, this is a blow off top that we're stepping into. The blow off top may rip for 5, 6 months, a year even, but there will come a time when the money halts, the valuations halt, and you're going to be sitting there while the thing crashes. First, you're going to see, there's a chart, I don't even have it pulled up, but I always remember it, that shows the bull run, right? Everything goes up, and we're in that euphoria stage of AI right now, where everybody's thinking it's going to go up forever. This is different this time. Everybody's going to make money. Just put your money in, liquidate your assets, sell your house, rent, invest into the stock market, and everything will be hunky dory. The problem is that so many people are thinking this. And this is typically my concern, right? When I'm looking to invest and I'm talking about something, people who say, no, that's never going to work, blah, blah, blah. And that's the genuine consensus. Now I want to look a little deeper, right? Because, okay, well, let's look at the next 3 years, 4 years, right? What's going to happen? Is there development? Is there a good team behind it, et cetera? But when everybody is putting their money into the same stock or the same investment, you're wondering, why are so many people doing that? And if it was that easy, everybody would be a millionaire, right? But unfortunately, that's not the case. Now, this is where we talk about semiconductor stocks, right? Stocks are now trading above the 200-day moving average by the largest margin since the dot-com bubble burst. Oh, what the heck is that? That's crazy. Let's reference this for a second. Dot-com bubble, 1999 to 2001. 2008, 2009, the bottom. We have been on a steady tear. And you notice how this most recent, that was just shot up. Why? Because in 2022, they came out with the ChatGPT, which was this new AI system where people could now use them to generate all sorts of things, where they then evolved into being able to generate business plans and being able to use them for legal to a certain extent, and now being able to generate videos with AI, right? And we're seeing all this development, and it's so exciting. Everybody's just locked into it. They're like, oh my God, it's crazy. I literally have a widget for ChatGPT on my phone right here, and all I have to do is click it, and I'm in ChatGPT every day. I use it to set up systems for computer, or for my business. I use it to remember data, so then I can talk to it. And I use Claude now, but talking to Claude and saying, hey, I did this today. This is what I did with a realtor. This was the negotiation. What did I miss? Did I miss something here? How could I have done better? And ChatGPT or Claude will then remember these things, and then it'll go back through and say, hey, no, this is what I saw. This is what you missed. This is what you didn't share this. Give me some information. It's like having a personal assistant in your pocket. And the thing is everybody thinks that it's just all of a sudden the whole market's going to shift and everybody's going to use AI and it's going to be all this productivity and the stocks are going to go up, 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 up. But that's the problem. That's the problem. There's overconfidence in this market right now, and that market can run for some time. Don't get me wrong. I think it'll be great, but the problem is most of you aren't going to pull out when the time comes. And when you see major increases, we saw this in the crypto boom in 2021, right? All this money got pushed into the economy, which went to the crypto market. You saw Bitcoin go from 6,000 to 69,000. You saw Ethereum go up to almost 4,000. You saw, I don't know, XRP went running on that during that time frame up to $1.50 from like 20 cents. I'm trying to remember. Solana went on a tear, but everybody lost a bunch of money because nobody knew how to pull money out. Me included. I mean, that's when I stepped into the market. I stepped into the blow off top portion of the crypto market, and now I'm down a lot in some stuff. I'm dollar cost average my way out of it. I'm actually at a point now where I'm pretty level, but for the time I really got to sit through 2023, 24, 25 wondering, Jesus, did I make a bad mistake or what's going on here? Well, I started to understand the economy, understand the cycles, and now I'm really set myself up for success in my opinion. And because of that, I got really disciplined on how I invest my money. And now I'm building my first inventory home this year. We have 14 homes under contract. I think 13 for new construction, 14 after tomorrow. And business started booming, and then we started investing our money better, right? But most people don't pay attention to that. They put their money into something hoping it'll go up forever and ever, and then they leverage against it. We haven't quite we're starting to see leverage. That's where you really want to get nervous. If people are leveraging their mortgages, their 401ks, all of this stuff to buy into a stock or a particular set of stocks, that's when I really feel like we're on shy ice. But anyways, breaking semiconductors and semiconductor equipment stocks are now at a record 18% of the S&P 500 total market cap. So 18% of the total market cap comes from semiconductors and semiconductor equipment. The biggest weighting since the single industry group. Percentage has more than tripled since 2022 since the 2022 bear market. That was again after COVID. By comparison, the peak of the 2000.com bubble, tech, hardware, and equipment peaked at 26%. Furthermore, the semiconductor index SOX relative to Magnificent 7 is up 85 points, the highest since the mid 2020. This comes as the SOX has rallied 159% since the start of 2025, materially performing the Magnificent 7's gains of 30%, outperforming. The run in semiconductors is unlike anything in market history. So you guys, when you see something going up like this, you might be able to catch a ride to the top. But the thing is, you don't get into something after it's ripping and it's green, that's 1,000% up, 150% up. You buy into it when the market's garbage. So I'm paying attention to the portion of the markets that I'm confident in that aren't doing well now because the market is not normal. Like I said, there's nothing on paper that shows that the S&P should be at these levels. If you have something, please share it with me. But I have not seen anything. All I've seen is an overvaluation of AI companies, semiconductor companies that are valued 20%, almost 20% of the S&P 500 is semiconductors. That's why it's running, because companies are seeing insane valuation gains because of the anticipation of AI and semiconductors being a humongous portion. Well, majorly because of data centers, right, for semiconductors, because those are tons of computers. If you look at Utah, they're ready to build like a huge 40,000, like bigger than Manhattan. It was like 40,000 acres or something like that. Don't even get me started how crazy that is. And then you have the AI companies where they're saying we're going to be able to, like, imagine AI is getting to the point where, I'll be honest, I'm looking to hire an assistant. I probably won't need one in 3 or 4 years. I can use AI to handle everything I need it to do. But we're not quite there yet. We're not quite there yet, no matter what anybody wants to tell you, right? And then bloodbath in the Asian markets as of this morning, or yesterday night, good Lord. At about 11 p.m., Taiwan, Japan, and South Korea all saw 133 billion drop, 70 billion drop, and 99 billion drop. Because the cracks are starting to form, and not only that, but they're starting to really showcase there's weakness in the market. And again, we kind of talked about that a couple of times today, so I won't bore you. But um, this has a fact check on the bottom. We're not even going to worry about that just right out the gate. But what I want to pay attention to is Michael Burry has reported that the upcoming public listings for SpaceX, OpenAI, and Anthropic are going to pull more capital out of the market in the entire dot-com wave of 2000. Adjusted for inflation, just these three companies will raise more money than the hundreds of tech firms floated into the market peak of the 2000 bubble. So right now, there's so much money being put into those three companies. I just feel like the IPOs are going to be over anticipated. People are going to think that they're buying into something that's just going to go up forever. But it might be one of those where it just rips for a little bit of time. You're going to see a 30%, 100% gain at those who buy at the opening bell when the IPO launches, and the insiders are going to dump on you. They always do it. It never fails, right? So those of you that aren't accredited investors that are just holding on to a couple $1,000s and you're going to push it into the market when the IPO hits, I'd be careful and I'd have stop losses set in place because it might run. It very well could run for a while. But when I see stuff overhyped like this, it leads me to believe that we're getting to a point where we're probably going to see a downward turn. That's not a pessimistic view. It's just reality of where I'm seeing the markets right now. But we've made it to the end of the video today, you guys. We talked a lot about the crashes and what we should be paying attention to. If you guys like what you see, make sure to like and follow for more. And if you guys have any questions, put them in the comments. We'll do a video on it. We'll go into it a little bit more deeply as we continue to do these videos. We start to understand stuff more and more, understand the market more and more, and we want to make sure that we continue to provide that information to you. So thanks for watching. Have a blessed day.